This episode is sponsored by Lupton Capital, which provides a variety of investment services to both retail and institutional investors on platforms such as Seeking Alpha, Substack, and StockTwits. For more information on these services or for links to those services, please visit luptoncapital.com. Hey, everybody. Welcome back to the Investing with the Whales podcast. My name is Jonah Lupton. I am your host. Super excited today. We have an Australian with us, my first Australian on the show. Meet Andy West. He is the co-founder of Longlead Capital Partners and Headquarters. Is that correct?
That's correct. G'day, Jonah.
Great. So you are in Australia. Where are you, in Sydney?
Based in Sydney. Yeah.
Okay. And you were running a hedge fund, recently shut it down, returned capital to investors, and opened up a family office. That's
right. So the story here was I was deputy head of fundamental strategies at a shop called Regal Funds Management, which wouldn't be known to most US guys, but it's Australia's largest long-short hedge fund. Was there for a decade, and then took the opportunity in 2013 to jump out and launch my own shop with my co-founder Tim Campbell, and that was Longlead Capital Partners, global mandate, equity long short, focused on core Asia at that time, doing exactly what we'd done before, but with the opportunity to really utilize our process, which I'll go through today, which I think is pretty topical in the way we look at things. So after sort of nearly 10 years of doing that, we decided to return the capital at the beginning of 2022, which was great timing, and just focus on our own investments. And so today, run my own money, building headquarters to launch this year. And that's all about bringing people on board, building a community of like-minded long-short investors who can sort of see all the way and experience it day to day of the way we looked at things, correlated data points, connected the dots between all the various databases that you see. So you get more of an insight, more of a complete picture on what's happening and therefore can make better decisions.
Now, for people watching this that aren't familiar with long-short strategies, can you just explain what that means?
Yeah, equity long short has a variety of flavors around it. We would run two flavors for the better part. I mean, this is an interesting story. I started an equity long short the month Bear Stearns collapsed. That was
really
back in 2008. Yeah, which was a real baptism of fire. It was fantastic in the sense of being able to go short. I'd come out of private equity, where I'd been nearly a decade in private equity before that. So long short, from a fundamental standpoint, we're not quantitative, never have been, all fundamental bottom up stock picking. And we ran two strategies: market neutral, dollar long, dollar short, hedged, essentially targeting a portfolio that focused specifically on stock specific alpha. So you hedged away your market risk, you hedged away largely sector and factor risk, and focused it down on the things you could control, buying great companies that had events or stock specific dynamics that made it more predictable to outperform its peers, and shorting companies on the other side that were just the opposite: expensive, walking into headwinds, medium term underperformance likely through earnings drawdowns, etc. And then the other side of that, we ran an absolute return strategy, and the difference with absolute
return. Did you try to set up pair trades? If I'm long Nike, I'm short Adidas, that sort of thing, or not really?
No,
not sector specific in that way.
Yeah, so we were very much independent alpha longs, independent alpha shorts, and I still do that today. Pair trades some guys do it really well. You've got to be, very purist in your focus on pairs, because your risk is you hedge away all the risk and get no return. And a lot of people have seen that running that strategy. So the pure pair traders, the guys who are still around doing it, they've been around, 15, 20 years, and they just have better systems, better processes, and it's 100% their focus.
Right.
Independent alpha.
The last 5 years, if you were long AMD, short Intel, that probably would have been a good pair trade. But in a bull market, those pair trades are hard to pull off.
That's right. You can probably define 5 at any point in time that seem, pretty high on your conviction list. But a lot of others the situations with the companies change so rapidly, you just get churned in and out with your short outperforming for periods, then underperforming, etc. So, independent alpha stock picking, what that means is we're looking for individual companies that we really like from a long or short perspective. And then we put those best ideas together in a portfolio and look at the sum total of risks. We measure it in through various lenses, through your market risk, your stock, your sector risk, your factor risk, etc. And you make sure you're comfortable with the totality of those risks. And then you can package that up in a variety of gross and net exposures. Absolute return was the other strategy where we boost the gross, boost the net at the times your markets are rallying, and do the opposite in the other times. It's more of a higher vol, higher returning strategy than market neutral. Market neutral was all endowments, large family offices. Absolute return was your high net worth investors that want that more sexy return profile.
Gotcha. Okay. I'm guessing a lot of the people watching this have never launched a hedge fund before. And I'm not sure if launching a hedge fund in Australia is exactly the same as launching one in the US, but take a couple minutes, just kind of walk us through that. What does it take to actually get a hedge fund off the ground? And did you guys, seed it with your personal capital to start with, or did you have some big institutional investors that were part of the seed capital, and then you went out and raised more money after that?
Yeah, so the process itself, if you're running hard, fast, and very efficient on all your paperwork and understand and get good partners with your prime brokers, you probably could do it in about 6 to 8 months, woe to go, with all licensing and that sort of thing. But, it's a process and it's a full-time job to do it. It's complicated, but it's rewarding when you do get it done. So,
and can you do most of that yourself, or is it the lawyers that are doing a lot of it too?
Look, if you put it in the hands of lawyers, you can do that.
Right, it just gets expensive.
It's probably 1 to 2 mil in total. That's your setup costs.
Wow.
Right? So you've got to roll up your sleeves and do as much as you can yourself. But it's no real different from a regulatory standpoint, because we were a group that targeted global investors. Probably a third of our investors were US based, a third Europe, a third Asia. So we set up our hedge fund was actually based in Singapore to be in that hub of Asia and the global markets, which is a good environment for capital raising wherever that capital is coming from.
There are tax advantages of being in Singapore too, as well, right?
They can be.
Is that just personal income?
Yeah. It really comes down to your personal. So, from a tax perspective, Singapore itself, if you're resident in Singapore, you're accessing Singapore resident tax, which is a lower rate, which is good. If you're like me in Australia, you pay Australian tax rates. So It's not really driven by that. But the funds themselves, same as any US hedge fund set up, Cayman Islands based. So it's flow through for tax. That just means the investors get to pay their tax wherever they're located and resident for tax purposes. And that's a pretty standard structure.
Gotcha. Now, long short, when I think of long short, I think of 130% long, 30% short. Is that still the way that long short funds do it, or like you said, there's so many different flavors?
So a market neutral, a fundamental market neutral, is probably going to run anywhere up to 250 gross. Okay, and remember that's a sum total of your longs and shorts. So given you usually market neutral, that would be 125 long, 125 short. So you're not using a hell of a lot of real leverage. Your longs are levered up 1.25 times. But we would average about 200 gross, so 100 long, 100 short. But that would vary depending on market conditions. We as part of risk management, you cut your bets when the factors that your process exposes you to go against you. And that's certain market environments. Any strategy has that. It doesn't matter what type of strategy. You have to know what factors are implicit in the way you pick your stocks, and know when to magnify your leverage and go up to gross of 200 to 250 and cut your leverage back to 100, which would only be 50 long, 50 short. So that risk management piece on market neutral is as important as your stock picks. From an absolute return perspective, yeah, we would run that anywhere up to 300 gross at times. So, and that might be 300 gross, 100 long. And at the bottom, we'll run it net short if markets are in a bear market. So that hedge fund aspect is very much about dynamic gross and net management, as well as dynamic position management inside the portfolio.
So let's say you were still running a hedge fund today in this current market environment, all the macro headwinds that we know about, banks starting to get into some trouble, certainly some stress in the US banking system. Now it looks like Europe has some stress. How would you be navigating this environment? What sort of exposure would you have on? Or would you just be kind of hanging out in cash? I mean, I know when you're running a hedge fund, you're not really getting paid to be in cash necessarily. And that's where the long short strategies sort of work out better. But or in the family office, right? Where you're not getting paid to manage anyone's money. You can do whatever the hell you want. So
yeah, and that's the difference now. With the family office strategy, I can choose to be sit on the sidelines, and something I was mentioning to you earlier. Your benchmark right now with the uncertainty out there, particularly that's raised in the last week with the deposit runs in the US on the smaller banks, where we're sitting there debating Credit Suisse overnight, that sort of thing. Those issues might be solved, but for now they are material. And so you sit there and you say, well, what's my benchmark return? What can I get with the lowest risk? And there is no alternative right now for cash and bills. That's your benchmark. If you can sit there and get 5% risk-free, whenever you look at a long or a short, that's what you're asking yourself at any decision point. Is this on a risk-reward basis better than risk-free 5%? And so that's different to when you're running institutional money. Institutional money, they're paying you to run it. You're running 100 gross or above at all points in time. So where would we be sitting and looking at right now? Well, it comes down to, let's just take that net perspective, the net exposure. How much market risk do you want to be running right now? You've got the S&P 500 sitting on 17 times forward earnings, and you've already had interest rates go from 0 to, let's call it 4.6. Let's debate whether it's going to be 4.85 on March 22 or whether they'll pause. We don't know. But that's a big increase in the price of money, and that has an impact on fundamental asset values. And what you've seen is the biggest impact has been in the bond market, right in the centerpiece of what's directly and most exposed. And that was the story of 2022 with all the bond losses through there. Equities derated. We came down from the low 20s forward PE to 17 to 19 times. It was only a week ago or a week and a half. We're probably at 19 and we're back at 17. Earnings are still going down. That 17 times, to put it in perspective, based on the cost of funds plus corporate credit spreads, is not cheap. Right. We can easily justify in this cycle that equities should see a 14 times PE, just based on what's happened to cost of funds today.
I mean, during the great financial crisis, markets got cheap. That's when they finally bottomed, when everything just looked so freaking cheap. You had to go in there and start buying.
Yeah. And so you've got to say, why haven't we seen that yet in equities? And we haven't seen it, and this gets to interpreting the kind of cycle we're in. We haven't seen it because, unlike the GFC was a credit cycle. It was about loans going bad and the whole system starts to seize up. And that affects the real economy very, very fast. So companies, company earnings, etc. What we're in right now is an asset cycle. It's about the investments. It's about the price of money. Whereas the credit cycle is still pretty good. It was only a month ago that we're all looking at the economic stats, retail sales, industrial production holding up, retail sales, bounce in housing, market indices, etc. It was looking a bit better. And GDP is going along at a reasonable rate, albeit it probably slows a bit from here. So that shows you the real economy hasn't been largely affected. And that's why the S&P 500 is still on 17 times, because it's had a derate to reflect some of that cost of money increasing. But the derate from 17 to a 14 is when you see corporate credit spreads really spike. That's when, bond investors are saying, hang on, these companies are starting to show some stress in actually being able to pay their interest payments. We're not there yet, but that's not to say we won't get there in 6 to 12 months. So to your question, how do you sit right now? You can't, it's very difficult to have a particularly bullish outlook on equities in anything under a very short-term horizon. And, there's been 13 plus minus 5% movements in the S&P 500. You do want to take advantage of those tactically, but I keep saying the story this year is rotation, rotation, rotation. Don't chase a 5% move because it's probably going to go backwards in your face, given the broader trend is increased pressure on the economy, slowdowns continuing, and now stress appearing initially in the regional banks, Credit Suisse, these sorts of things. And depending on the resolution there, seeing whether that percolates more broadly into the real economy, which would be the next leg down in price earnings multiples.
So just out of curiosity, I don't know how much investing you do in the US versus Europe versus Australia. What do multiples look like outside of the US? I assume they're cheaper. How much cheaper?
Yeah, so if you're looking at Asia, and particularly, Asia is largely Greater China. So when we talk Greater China, China, Taiwan, Hong Kong, and we know what happened there. They were stuck in their hard COVID lockdowns for a long period of time. Chinese PEs dropped to rebounded on the reopening news, but they're drifting back down as people start to realise that this isn't a extreme reacceleration. It will take time, and so there's probably been again that thought of rotation, some over optimism, and it comes back down, but still very much cheaper than the US. Australia, for example, similarly. We're sitting there a bit cheaper than the US. Personally, my viewpoint on the Australian market is Australia has a good chance of hitting recession earlier than the US, and you see further derate on that. The reason for that is quite simple. The housing market here is very much variable mortgages, and the stress is coming into that space earlier and quicker, and we're starting, and we're already at full employment. So in the sense of where in the US you're seeing that excess labour demand, Australia had a very different response to the COVID pandemic, and all the companies filled their employment rosters very, very quickly afterwards. So we haven't got that tailwind of a strong jobs market. It's probably rolling over now.
What does inflation look like in Australia? Did it ever, I mean, I'm assuming it didn't get as high as Europe did, because Europe had the, cut off from Russia and everything started getting jacked up after that happened. But what if things look like in Australia? Do you guys have a CPI and a PPI and a PCE?
Yeah, we measure things exactly the same way. So in Australian equities and the Australian economy, CPI is about 8%, just coming down now. So we're call it 6 months behind the US, and the reason in those trends Australia's behind the US is because of the pandemic response. We had a harder lockdown schedule and came out of that much later. So all those pressures hit the economy later to push CPI up, and it's really just coming down now. But it's interesting because, exactly what I talked about, the pressures on the housing market, similarly to the US, house prices went through the roof during the pandemic on zero rates. Australia had never had quantitative easing. We then put it in place and had a couple of years of it. And that just, put gasoline on the fire.
So all of these central banks were doing the same dumb stuff at the same time.
Yeah. And Australia was kind of just late to the party, and then did it, and then went whoops. And so we're sitting there with 8% inflation just coming down now, but with interest rates only at 3.6.
Oh.
And they're saying,
I assume they're on the way up still, right?
Well, this is the thing. They've kind of signaled they may pause here. So they're pausing on
because they see
market fears.
They see the bank stress in the US, and they're worried that that's what they're going to bring onto themselves if they keep going.
But they're also seeing mortgage stress, and it's what we call the mortgage cliff here in Australia. everyone fixed their rates, but our fixed rate market is a short-term fixed rates. It's not like the US where you get a 30-year fixed mortgage. You get a 1 to 2 year to 5 year fix, and they're all rolling off. So about now,
that's what caused the problem in 2007, 2008 in the US. I mean, there was more to it than that, but everyone was going out and getting these adjustable
resets,
interest-only mortgages.
Yeah, that's exactly right. So the question is how much consumption that erodes very, very quickly, and we're all waiting to see that retail sales tip down. It's starting to fall, etc. So Australia is this peculiar two-speed market where you've got the west coast of the country. It's very much a materials energy market, very integrated into China supply chains. And so that's kind of having a good time right now. Aussie dollar falls, commodity prices are up, party time for the miners, but only so long as global demand holds up. And we're probably starting to see global demand soften faster, which brings commodity prices down and the pressure comes on there. But on the East Coast, that's where the population lives. So it's very much your conventional consumer market, retail, education services, etc., and a little bit of manufacturing, and that's already under pressure.
Now, what is Australia known for? Do you guys have any of your own kind of homegrown commodities, or do you guys have to import everything?
No, it's very much a commodity market in terms of a commodity export market. So everything from agricultural commodities, wheat, beef, barley, cotton, lamb, etc., to the big ones, iron ore. That's the biggest part of Australia's terms of trade.
What about oil and gas? Do you guys have your
own? Oil and gas is okay. Big, but coal is actually bigger.
Huh.
And the long-term future for coal isn't so rosy. But as China came back into the market, we got slapped with the China pushback for the Prime Minister in the pandemic, coming out and saying we need an investigation into the COVID origins. And so they put export controls or import controls on Australian commodities across everything, and coal just stopped. It literally went to zero. And that's just coming back now. So there's these short-term kind of ups and downs in that commodities piece that supports things for now. But it is at its core a commodity-driven economy, like call it Korea. Only Korea's more consumer goods exports, and that puts it at the mercy of global demand. And so, when you look at a global demand picture slowdown, which is what we're facing, Australia's usually pretty sensitive to it, and you often see the Aussie dollar fall quite heavily over those periods of time.
Are you guys as reliant on China as the US seems to be, with regards to manufacturing and importing some of that cheaper stuff over here? Do you guys do the same thing?
Probably more so.
Okay.
Than the US. Yeah, Australia's manufacturing industry, we've got very high wages. So for 20 years, as China, modernized their manufacturing base and moved up the value-added curve, a lot of that Australian manufacturing just died, withered, and went across there. And there's not a lot of any particular note here. There's big Australian companies well known for their brands, but they largely operate in the US or in Asia or in Europe now, and just happen to be legacy listed in Australia.
Yep. What are your thoughts right now on macro? And just so I know, what percentage of your investments are in the US versus non-US? Is this the market that everyone really goes to right now?
Yeah.
Still?
Yeah. Right now, 75% is US centric. So, the rest is in Asia and a little bit of Australia, and some of that's currencies as well. And so, when we sit there and look at the macro, particularly US focused macro, we all know what the key issues are. Okay. So we've got inflation, and sticky inflation at that. And we're getting new data points all the time, and that's driving Fed policy. Now, let's hold aside what might change for now based on some of the banking stress that's coming in. That's an additional factor we need to consider. But let's just look at where we were even a month ago, we'd had inflation peak and fall and coming down, but very much on the good side. And when you pull out of the inflationary puzzle the different components, you are seeing much lower goods inflation and goods disinflation, really. But that services side, and even everyone says, well, it's mainly housing driven. It's not all. That, core services inflation ex housing is going up. It's accelerating still in the US. And that's a concern because that's a big focus for the Fed. So you're at this point right now where, and if you look at something I tweeted the other day and back in December, pulling apart all this stuff, don't focus on headline CPI from here, because headline CPI, let's take the next month. My bet is headline CPI year on year will fall 100 basis points from 6 to 5%. That's not a good signal, because what is inside of that is core inflation actually not falling at all. And next month, you'll probably see the first month where headline inflation falls below core. And so there'll be part of the market sitting there cheering, see, headline inflation's coming down. Isn't that great? Inflation's going away. But core is more important to Fed policy and the rate path. So my forecast for core inflation next month, we've just had 5.5 year on year. I think it'll sit at 5.5, and it might even tick up to 5.6 year on year. So that tells you that the pressure remains on the Fed to continue hiking rates. And it was only a little while ago we were expecting 50 basis points, and now we've got a bit of banking stress in there. And the question mark is it enough to knock them off their path and pause? And you've had everyone from Goldman Sachs come out and say no hike. They'll wait and see. What you got, Nomura cutting 25 basis points. I think that's, I'm not in that camp.
Oh, I don't see that happening. I mean,
yeah.
we might get a couple of rate cuts at the end of the year, but I think we're still, or unless the banking system gets really bad and you start to have more failures. In terms of, so there is stress in the banking system, right? 3 banks have failed. Others seem to be in a little bit of trouble getting some liquidity injections from JP Morgan, et cetera. If that tightens up credit standards, if the average, Joe Blow on the street hears about banks failing and now gets worried about, some of his discretionary spending habits because he's afraid that this is 2008 all over again, do you start to see less spending in the economy, and that starts to bring down, some of the inflationary pressures that have been keeping CPI sticky?
Absolutely, and that's the question mark now. Really, I'd take that viewpoint and say absolutely. The question is over what time frame.
Right.
So what we're facing right now, whenever you have a banking crisis means credit growth slows, and when credit growth slows, that's when you see that piece of the macro hitting the real economy. And we talked about that with respect to the S&P 500 forward PE, and earnings growth starts to decline on a faster basis if that happens, etc. The thing is, though, the stress is very much at the smaller end of the banking market. And normally you'd sit there and say, well, the small end of the banking market, the US, is about only 30% of credit. Okay, so 70% of credit's the big banks. But when we look inside the credit growth numbers for this year, it's really interesting, because what you actually see is the big banks had rapidly pulled back on new credit growth, and the small banks had maintained new credit growth at peak levels. And that's right up to the latest weekly, monthly numbers. And to such an extent that small banks are contributing about 50% of credit growth in the US economy. And that's to real estate, commercial real estate, consumer loans, auto, all these sorts of things. So I'm a little bit concerned that the idea that it's small banks, don't worry, credit growth won't be hit, is a little bit different, because that traditional mix has changed rapidly. So small banks will have to pull back on credit growth. We'll see how much impact that has. It will happen over a period of time. and it will reduce the growth environment. There is no doubt about it. It'll start to hit personal consumption. And what does that mean? Well, if you look at, we had 2 quarters of negative GDP growth at the beginning of 2022, okay? And everyone went recession, 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 but it was brief. And it wasn't recession because we still had a strong labor market in the US. And that continues today. So we're sitting there and saying that won't change rapidly. It will change at the margin. And then we'll have to watch that like a hawk to see whether additional things come out of this asset cycle that adds to that pressure. So remember, we've talked about, okay, the hold to market losses of the banks, and that's what's driving this. The banks, a lot of these small banks, if you look at their adjusted tier 1 equity capital ratios, they've halved. If you take those hold to market losses, they're well below where and it's not sustainable. So they need to recap. It's just that investors won't recap them while CS is on the brink and CDS prices are going through the roof. You only see the recaps appear when price to books on these banks are sitting well sub 1 and there's just a very good risk reward. And the reason why bank recaps make sense in this kind of cycle before loans get bad is because if it is just hold to market losses and restoring tier 1 capital so you can get confidence back in those banks, well, that's done by raising money. And so you actually get a re-rate of the bank that's substantial back to, if you add that capital back in, back to 1 times price to book or thereabouts, or even higher, if you can totally remove the issue. So there will be the better of the small banks working with their investment banks right now to say, at what price could we get a raise away to bring confidence back? And the best terms will be for the banks that react earliest. It's probably a little bit too early right now for investors to really want to step up. So at the core, credit growth starts to slow. That can bleed into the real economy. That does bring down personal consumption, and personal consumption is what's held up GDP growth in these last 2 quarters to be nicely positive. So you start to see that picture of GDP growth slows again, and consumption continues to slow, and then we see if the stress goes from banks to real economy over a 6-12 month horizon, for that broader recessionary aspect to appear.
So a couple of questions I want to throw in before we wrap up. One, do you think Warren Buffett and Berkshire end up with any banks before this is over?
I reckon they'll participate heavily in the best banks equity recaps. There's no doubt about it. They've done it before. They've made good returns out of it. So why wouldn't they be there again? If this stays just an asset cycle and stays out of the real economy, they can be very, very good trades.
Oh yeah. I mean, was it Bank America? They got some preferreds back in the GFC. I forget, might have been a couple others too.
Goldman's, they did something with as well.
So you're right. Yep.
Yeah. And I think, isn't Warren Buffett, has he come out and said, I wish I didn't do the preferreds, I wish I just took the equity? But it was
maybe. Yeah. I mean, he probably would have made more the equity.
It was still the right thing to do.
Right. You also mentioned commercial real estate, and I've heard some people speculating that that's a ticking time bomb waiting to go off. Any thoughts on that? I mean, could there be some potential disasters down the road in the was it CMBS market?
Yeah, I again, it's one of those things where I think it's inevitable. It's just how big they are. When you start to see PIMCO really screaming about, shoring up the system and that sort of thing, and renegotiating terms of loans on their commercial real estate portfolios and funds, and BlackRock doing the same thing, and doing technical defaults as strategic measures to force banks back to the table. They're the big guys, they can do that. The smaller guys can't. It's take it or leave it, and they're very liquid assets. And again, you have that asset liability mismatch. In the good times, a lot of people set up funds that have quarterly, monthly liquidities, that sort of thing. Investors can get out, but they can't rationalize the assets that quickly. So that's where the stress appears. So that sort of thing is clearly an area of pressure to watch. The stocks are already well down. So it's hard. I have a rule. If something's down 75%, you don't short it because, you're at a massive squeeze risk. You've got to be pretty confident of total bankruptcy to want to get involved at that point. And every day you hold something is technically a reinvestment point if you've got liquidity to trade around the market. So it can, and some of these small banks, again, have large commercial real estate portfolios. So when we say hold to market losses on bonds, well, that's only one piece of the puzzle. Outside of the high quality liquid assets are less liquid assets, and there's losses on those in this asset cycle that we haven't even looked at. So they'll be focused on pretty heavily.
Are you shorting anything in this market, or not worth the time, not worth the risk, especially because a lot of stuff's already down so much that you're just sort of...
So being very tactical. So as I said, benchmark, cash and bills, and then trading around extreme price movements. So let's, when you bring up the banks are falling here, they're plummeting. It brings down the big banks as well, the banks that are very good. If you have a period that, okay, the BTFP and various other measures for Credit Suisse removes the stress for a while, well, guess what? That's a great rebound trade for me. And I'll look at participate tactically on a rebound in the big banks, the high quality. If you look at the shorts, right now, a lot of things are down. It's well discovered this cycle so far. It's no surprise to anyone. But there's areas I'm focused on just watching. Take the industrial distributors. You've got Granger, Fastenal, MSN, these sort of companies. They're all up on highs. And they're up on highs because wholesale trade and manufacturing hasn't yet gone year on year negative. Industrial production's still positive slightly. It's slowing. But that's the next phase. It will turn negative. And whenever you look at industrial production going heavily negative, those industrial distributors are the supply chain conduits to that. Their customer base is cutting, and they have large inventories. They do need to reduce pricing. They need to clear that sort of thing. They've got large cash balances, so they're better positioned than any other cycle, but they will feel pressure, and they're at peak PEs, peak earnings. So that's interesting. My process is always about separating the multiple from the earnings and looking at both. I want to be short things that are just about to turn the corner, where the pressures, the consensus is still long, and that's industrial distributors right now. The PEs are peak, and they're well above trough or even mid-cycle levels. And the earnings are going to come down as the pressure appears, because you get then the combination of earnings surprise on the short side, multiplied by the cut in the PE. Just like if we said the S&P 500 PE at 17 times hits when recession hits 14, 13, something like that, well, guess what? All those sectors are going to be at lower multiples as well. So you want to be short the ones to get the underperformance that are at the higher PEs with the earnings still to be cut. That's really interesting. I think the optimism that came back into home builders is just too much. And there's potentially good shorting there across that sector.
I'm surprised at how well the home builders have held up recently. I mean, up until a few weeks ago, some of them were trading near 52-week highs.
Yeah, and you've got to look at positioning around that. So, everyone goes, why? Well, the housing cycle is incredibly well understood and well known and well traded in every single economic cycle we go through. So you see those companies get hit first as interest rates start to go up. But it's really easy for an analyst to cut its earnings. It's very hard for an analyst to get the timing right on those earnings. And that's what's been wrong. They've all got the earnings down, but the earnings have held up better because, as I said, real economy is still, it's bad. It's slowing, but it's not a disaster. Housing's coming down, definitely house prices falling, but the home builders still have contracts in hand they have to work through. You see that in units under construction, hasn't really fallen yet, but it's just about to. Any index, starts minus completions, is negative, and that's your leading indicator. Building permits is negative. The leading indicators are all pointing there. So the earnings pressure will just be slower this cycle than 08. It's not a disaster. Housing, real estate was at the core of 08. It's not at the core of this cycle. It will be a slow burn down.
Because everyone has a locked in 30-year mortgage at 3% or lower. It's just there's no transitions. Like no one's upgrading or downgrading because they don't want to sell their house and have to get into a new mortgage at 7.5%. So
wouldn't it be great if you could sell your mortgage with your house? Because you could
for real,
really
seriously.
trade that cycle.
And go buy the next person's house with their mortgage.
Yeah. So home builders, I think further pressure comes on them just naturally in this cycle. So there's still areas too short, but again, with home builders, it describes that situation. The PE went back up as everyone went, oh, it's not as bad as we thought. It's not a total bonfire yet. So that provides an opportunity for me to rebuild shorts.
I mean, it feels like everyone's been waiting, and I don't know if we're actually going to get it, but the word of 2022 was capitulation. We're not, this market's not going to bottom until we have capitulation. Retail waves the white flag. They all sell their stocks, panic. And we didn't get it. Do you think there's a chance that we get it this year, or we just sort of drift lower or stay in this choppy range? And, I sort of feel like we're range bound for a while here. Like there's just.
Yeah, I agree with the range bound thesis. And that's why you've got to trade the small rallies and be nimble, sit in cash, apply yourself on the short when stocks have gone up, but the fundamentals are deteriorating. Apply yourself on the longs when things have fallen out of bed, but they're good quality companies and they will rebound because GDP is still positive, the economy is still chugging along, albeit slowing, and that describes that real economy still. And people have money. People have money to spend, so they're not going to suddenly stop, albeit they'll gradually reduce. And so the capitulation moment, well, you've got to think of scenarios. It can come out of financial stress. So we've got to see whether this current stress broadens. And I would have said, without Credit Suisse going bankrupt, no, BTFP should do something about it, albeit the banks that access that program will be profitless zombies. And probably wither and die on a very slow horizon. Those who recap themselves and get rid of that funding will be able to rebound and take some market share off them. So
it's sort of ironic that by Silicon Valley Bank and Signature Bank failing, they caused stress to the system, which brought down yields, which actually helped some of those longer duration bonds, which actually brought down the unrealized losses on the balance sheets.
and a lot of that was, and it gets back to, I guess, what I was trying to mention, positioning. So you look at the positioning that was in, say, 2-year bonds and 2-year bond futures, and that's something for investors to focus on. Get your CFTC data, focus on positioning continuously, see where people are max long or max short, and watch for the opportunity to do the opposite. Because people were max short 2-year bonds, hedge funds, etc., on the view of all of a sudden rates going through the roof and continuing up, and we were banking another 100 basis points of
just a week ago. We thought the terminal rate would be 6% or higher.
Yeah, and so they've gone too far on the other side now. As that, I mean, some hedge funds lost 10% in a month on those bets just in the last month. So, they've had to unwind those positions. That forced liquidation pushes it too far. So we could see rates rebound again, particularly if Powell feels that things aren't too bad, that he's contained the stress. He'll do 25 basis points, and all of a sudden everyone will go, oh, we are still on the rate hike path, and we'll go back the other way. So that's what I'm saying. Rotation. Don't just, see a trend and jump on top of it and expect it to continue for too much longer. It's more about doing the opposite of the trend.
So I sort of think next week Powell's going to hedge himself. So if he does no rate hike, he's going to sound hawkish and say, we're taking a pause now, but we probably still have more work to do. And if he hikes 25 basis points, he might then sound more dovish and say, we still have inflation, but we're near the end. This might be the last one, blah, blah, blah. So I'm curious. It's going to be interesting. Like, I feel like this is going to be,
it will be
very, very unpredictable of what's going to happen and what's going to be said.
We're going to see the whites of his eyes. What's he more worried about? Inflation or stress, right? Yeah. And so, as I said, core inflation 5.5 and probably not going down next month. That in itself says in any other situation, rates should be going up. And nothing's changed there, really, if they've cauterized the wounds of the smaller banks. So,
and they don't have an April meeting. So this is like, right, it's whatever you do next week is basically what you're stuck with until May.
Which means to me, and I've said publicly, I'm on for 25 basis points because of that. Like otherwise he's pausing for 2 months, and that could be a real problem for inflation. Financial conditions might loosen if BTFP has really solved the issue, and you have another wave upwards in inflation. And he's already had really 2 of these. We had one in sort of September, October. I picked and tweeted at the time it's going back up, and it did. And this year as well, in January, February, put out stuff to say we've got a bout of inflation appearing. And again, it did. They've got to sit on it. So, and that services inflation piece is going north. So at the core of everything, and he said publicly, that's what they're really looking at, core services ex housing. So they're between a rock and a hard place right now. But the outcome of that discussion is that there's more unpredictability about Fed policy now than certainly there has been for 12 months. And that's bad. That's volatility in markets. That's risk on and risk off waves.
Well, let's wrap it up there. Andy, thank you so much, man. Really appreciate it. What was it? Are you guys 12 hours ahead of us?
16. So it's a good time for me. It was morning.
So what time is it there right now? Morning time, right?
11 o'clock in the morning.
Oh, man. Okay. Well, thank you so much for joining us. Appreciate it. Definitely come back anytime. Once we're out of this messy, choppy market, we'll have some new things to talk about, I'm sure.
Absolutely. Thanks for having me on, Jonah. Interesting discussion.
See you on Twitter. Oh, just so everyone can find you. I mean, I'll put all this in the show notes, but if people want to find you, follow you, other than Twitter, anywhere else you're focused?
At the moment, at Andy C. West on Twitter, and they can go to hedgequarters.com and sign up a pre-reg registration, just because we'll be launching that later this year. Cool. And that's all about a platform that presents the data, or everything we've talked about, connects all the dots between all the macro down to the sector, down to the micro, down to the stock. So you can see why things are moving rather than just be accessing the databases that are already online of, balance sheet, cash flows, that sort of thing. It's about the why rather than the what, and it should add some value.
Awesome. Looking forward to that. Cool.
Great.
Thanks, Andy. Talk to you soon.
Thanks. See you.